Good evening. I'm Samuel B. Williams, and you're listening to Equal Ground Headlines. In a significant policy shift today, Canadian Prime Minister Mark Carney announced the cancellation of a proposed increase in the capital gains tax, a move introduced by his predecessor, Justin Trudeau. This decision is poised to impact investors, entrepreneurs, and the broader Canadian economy. Under the previous administration, a plan was set forth to raise the capital gains inclusion rate from 50% to 66%. This meant that instead of half, 2/3 of the profits from the sale of investments would be taxable. The rationale behind this proposal was to increase government revenues and address income inequality. However, it faced criticism from business leaders who argued that it could deter investment and stifle economic growth. Fulfilling a key campaign promise, Prime Minister Carney revoked the planned tax hike. He stated, "Cancelling the hike in capital gains tax will catalyze investment across our communities and incentivize builders, innovators, and entrepreneurs to grow their businesses in Canada, creating more higher-paying jobs." Carney emphasized that this move aligns with his administration's goal to foster a more conducive environment for economic development. The business sector has largely welcomed the cancellation. Many entrepreneurs and investors had expressed concerns that the increased tax burden would hinder their ability to reinvest profits into their businesses. By maintaining the current inclusion rate, they feel more confident in pursuing expansion and innovation initiatives. This policy reversal comes at a strategic time, as Prime Minister Carney is expected to call a snap election in the coming days. The Liberal Party, under Carney's leadership, has experienced a boost in the polls, positioning them favorably against the opposition. By addressing a contentious issue head-on, Carney aims to solidify support among both the business community and voters concerned about economic stability. Canada's economy has been navigating challenges, including trade tensions with the United States and internal debates over fiscal policies. The decision to cancel the tax increase is seen by some analysts as a move to bolster investor confidence and stimulate economic activity. By alleviating potential tax burdens, the government hopes to encourage domestic and foreign investments, thereby supporting job creation and economic growth. While many have praised the cancellation, critics argue that it may exacerbate wealth inequality. Capital gains taxes primarily affect individuals with significant investment income, and maintaining the lower inclusion rate could mean less tax revenue for social programs. This perspective highlights the ongoing debate between fostering a business-friendly environment and ensuring equitable wealth distribution. As the political landscape evolves with the anticipated election, economic policies like the capital gains tax will remain central to public discourse. Prime Minister Carney's decision reflects his administration's priorities and sets the tone for future fiscal strategies. Voters and stakeholders alike will be closely monitoring how these policies translate into economic outcomes in the coming months. Thank you for joining us on Equal Ground Headlines. I'm Samuel B. Williams.